Esteemed guests, it is my honor to be included as the keynote to this conference, and I wanted to thank the organizers for including me. I'm Kristle Romero Cortés, Associate Professor at the University of New South Wales, and today I'm going to talk about the role of financial integration and climate risk. So it's very topical. We hear a lot about climate risk and its effects, often on physical risks and what we can see with actual property damage. And we understand that this is going to have long-run ramifications in the economy across different types of geographies and across different industries. And my talk today is going to be specifically about financial intermediation and what climate risk means for the role of how banks actually will integrate and help in the economy. So a lot of my talk is based off of work that I've done previously, paper, for example, that I have with a co-author of mine, a paper named Tracing Out Capital Flows and How Financially Integrated Banks Respond to Natural Disasters. And this was co-authored with Professor Philip Strawn at Boston College and MBER. And the reason I want to talk about this is because financial integration in today's age is paramount to understanding what the economy can do going forward in both developed economies and emerging economies. So just to start with, fundamentally, financial integration means that we have savings in one market, right? And that could actually be financing consumptions and investment in another market. And we do this daily. We don't think about it anymore. We see that, banks are integrated across different geographies. We see that we interact globally. We don't have any issue with transferring funding from one country to another. We understand that there are investment opportunities in one area, and there could be more preference for savings in another area. Now, there are two ways to do this. This is a market-based finance, and then there's the more traditional financial institution situation. We typically think of banks as part of the traditional banking model, and we think of things like bond markets and credit markets or stock markets as the market-based financial network. Both of these interact obviously a lot. There are complementarities, there are some substitutions. But when it comes to the integration of these, we almost take it for granted. And one of the things that's very important to understand is that as we move towards a new normal post-COVID and appreciating more the risks involved due to climate change, we may have to understand that some of these things that we currently take for granted will need to be updated, or at least better understood. So why is this the case? Well, there already to date are barriers to integration, right? There are frictions. As much as I said it's easy to move money from one country to another, we know that we could pay transfer fees. We know that we can actually interact with areas that don't have necessarily the same creditor rights, right? So those things basically start with just what is the cultural interpretation of financial integration? What is trust like? What are the institutions like? What are the laws like, right? And within the same country, these can still have different interpretations. Adding to that, additional layers then of the actual regulatory regime, right? So in some areas, you're going to see a very sophisticated regulatory body that will interact with the financial institutions. Some areas you see that monetary policy and supervisory powers are actually separate. In some areas, they're combined. It may mean, though, that the regulation in one area can spill over and can inform another area, but it may not be binding lawfully, right? So there is that element of it is actually a learning curve to understand what's happening in another area and to fully appreciate the regulatory regime in that space. And then lastly, there is the mode that we now have an immense amount of information. When it comes to the hard information, we're already following that in levels that previously we've never seen. Add to that still soft information and the role for monitoring and the role for appreciating exactly what's happening once a loan has been made or once there is a financial investment, right? And that's happening daily. It's happening, across the globe. But what is still a little bit outstanding, what we don't necessarily appreciate really, is when there is some sort of shock to the system, how do banks react, right? How are the normal decision-making processes affected when there is some out of normal type of situation, right? So we have two key changes really with integration in the US and their local financial markets. We saw the role of securitization as it came on during the run-up to the housing crisis and what is known more globally as the global financial crisis. There was effectively a hardening of that soft information where you could look at scores, you could look at credit scores, you could look at something like a FICO score that captures all of this information that banks would have previously done due diligence on very specifically. Now you have kind of aggregated information. Also in the US, you would have run into a situation where specifically in the mortgage market for residential real estate, that you had government-sponsored entities that were also part of this process, right? So when we actually saw extensions of bank geographical domains and there was deregulation in the 1970s and 80s across states, you actually saw a integration in the levels that historically had not been seen in the US before. And this provides a really interesting setting because the US is very large, it has very diverse geographical markets, and it has a lot happening at the same time. It has metropolitan areas, it has regional areas, it has rural areas, it has things that we could consider more local with credit unions, with small banks, community banks. It has massive banking systems as well. And it all happens and they're all working together at once. This really means that it can give us this microcosm for things that we can appreciate, and then lessons that can be learned here can still be applied to other developed economies and potentially even emerging economies, depending on the lessons and questions you're asking. So if we're trying to get a better appreciation for the risks associated with climate change, it's actually very useful to still look at specifically what was happening in the US, and we'll be able to understand that in a very robust, very, lots of variation financial system can teach us what we can look at for other types of economies. But it's still the case how, we have lots of literature specifically about why do we care about financial integration. And really, you just see there's a large positive effect of the extension of bank branch networks. And we've documented this in the literature. Many economists have been working on this to really show you can have more economic dynamism, you can have overall better growth, lower volatility. Effectively, access to credit is good, right? And it does allow economic growth. This has been shown across many different iterations of this question. So we do care, and we want to make sure that there is an appreciation and a fundamental understanding of financial integration. And now my talk today is about what's going to happen when we see shocks to these markets and effectively this very robust system that's going along in a such a way that a lot of people rely on it. A lot of small businesses still rely on traditional banking, even with the introduction of different economies of scale, fintech, crypto, you're still seeing that the traditional banking model is fundamental. It's the cornerstone for depositors, for mortgage owners, for small businesses, and for large businesses that aren't as interested in going into the credit markets when they're initially starting off, because there's a lot of information asymmetry that can happen. And it's almost, in a way, fascinating that you could update in your information and keep it very clean when interacting with a model that's really well understood. And then you can go and kind of extend this to other markets. But competition is definitely enhanced when you see this integration, which means that banks then thrive, and the ones that don't survive, it's for a reason, right? So this kind of firm entry is good for growth, and it allows that these capital flows can move more easily across local markets, which then leads to better investment. So what happens though when there is a credit supply decline because banks have reallocated the investment to other markets with high credit demand? So specifically in the paper that I'm talking about today, we look to see what happens when one area is hit by a natural disaster. How is an affected area that's connected via their financial system affected after the disaster that was not hit at all, right? And so, credit supply response very clearly by the bank characteristics, if there were large banks, if there's small banks. So we're going to focus on small banks, specifically those with less than 2 billion assets. And we really want to understand that the reason for this is because when you look at large banks, even when you look at very large disasters, that it's still the case that very large banks can absorb those types of shocks in a way that small banks cannot, right? Because large banks are very large, and disasters happen very frequently now, and we see that they're actually very large as well. But in comparison to overall class asset size for large banks, they're small shocks, right? So we need to understand what could happen if those disasters start to become big shocks on those balance sheets. We start to look first at what's happening to small banks where those then shocks are already very big. So what we find is that credit in non-shocked areas does decline by 25 to 50 cents per dollar of additional lending to a shocked area, right? And all of these declines come for loans in areas that banks do not have branches. So the banks want to shield effectively their areas where they are operating with market power, where they do know the borrowers, where they have a branch and they have local information, right? Their non-core markets is where they effectively will shore up that lending and maybe pass it to where they're seeing that really increase in investment demand just after a disaster. You also see that banks securitize more. So securitization got a very bad rap after the global financial crisis. However, it needs to be recognized that as a financial tool, it allows that banks recoup effectively that investment and can go out and make more investments, right? And lastly, banks increase the interest rate on short-term deposits in those non-shocked areas to attract funding. So we see, one, that they increase the short-term deposit rates, two, that they securitize more, and three, that they did in fact lend less in the areas that were connected to the disaster hit areas via their banking system. So that financial integration has spillover effects. It has this effect to effectively make it so one economy is directly affected via their traditional banking system from another economy's shock, which is in this case a natural disaster. And as climate risk is becoming especially important, to understand what it means globally, right? It doesn't necessarily only stop wherever that flood occurred or wherever that tornado occurred or tsunami or blizzard or hurricane, you name it, they're happening. And one of the roles of economists and financial economists specifically looking at financial intermediation and growth is to see these shocks are going to get passed around and really move through the financial market via the financial system. So we are we take it very seriously. We are very conscious that whenever we say something in our research, that it's going to be rigorous, and we're saying something that means it's beyond just the idea of potential correlation. We're claiming that this is causal. We're claiming that this actually happened because of something else. So the shock to the market, this disaster, it's true, certain areas could be shocked more. There's Tornado Alley, there's more incidents of hurricanes along the coasts, clearly. But the actual timing of a disaster is random, right? This is not something that we know will happen tomorrow, right? So you cannot prepare for this disaster tomorrow. You can get hit with it and then react to it after the case, right? So the timing is what's very important. And the data that we analyze is extremely micro level data. I'm talking about daily interactions. We aggregate it to the month, but effectively we'll see what happens just months after a disaster. It's actually really important to do this because when you look at the data at this level, you realize that the fact is this type of shock lasts 3 to 6 months, and then it kind of gets back to normal, right? So if you only have annual data, you're going to miss a large part of the story here. So I'm showing in this little figure what's happening where you're looking at two different banks, right? You have Bank A and Bank B. One bank operates in the market that got shocked, that got hit by the disaster. And then Bank B does not actually operate at all in those markets. And so that's another layer that lets us really appreciate exactly what's happening after these disasters hit. Because you have banks that are not hit at all, that kind of their daily normal activity is maintained. And then on the other side, you do have banks that are hit and they're effectively treated, and they're allowing us to see how those decisions after the disaster happen, and that way we're able to see what the causal results are of those shocks. So natural disasters are very prevalent. They're becoming more prevalent and frequent. But in this figure, I am demonstrating what the data looks like from 2001 to 2010 for the incidence of property damage specifically. So not the disasters themselves, but the actual amount of property damage incurred in thousands across the US. As you can tell, there's wide variation. And you're also seeing that effectively, in the end of the day, certain areas are hit more. You see that on the coastal sides because of very costly disasters, such as hurricanes, and then wildfires, for example, in California. But the whole US incurs some sort of disaster shocks, right? And that means that that system I spoke of earlier, where the US is really connected very widely across regional banking networks, they're all going to be integrated. And because of this, we're able to test this really well across the US. So finally, we're going to look at specifically what's happening with actual lending. And this is not the only study to document that bank credit demand does rise after disasters. So as I specifically spoke to earlier, we look at it per month. It's really important to do so. As you can see, right after a disaster, you're going to effectively see a small decrease in the idea that now people are just basically getting their lives back together. And then after that, there's a massive increase. And a lot of that has to do with the fact that they need credit to rebuild, right? And this is often the case with physical disasters. So we're able to look at banks at counties in the US, which are small geographic denominations, and monthly data. And again, we define a shock market as one that was actually hit by a disaster, and all the connected markets as ones that share a banking network across those two. So when we look at those markets, the ones that are shocked, they're not interesting to us now because we're trying to see what's happening to everybody else. So we drop those markets and we look at just the connected markets and appreciate what happens in those connected markets. And we want to look at what happens to lending, and we want to look at effectively why that lending is decreased, right? And we argue that this is happening because they're able to move funding from one market to another. When you have this increase in supply or increase in demand for the supply of credit, then you're seeing that they're going to effectively decrease supply in their connected markets. So we're able to do this because we have very different data that was available through the HMDA Act, so Home Mortgage Disclosure Act, and you're also able to see the securitization behavior of these loans. By doing this, we look at the natural disaster data, we look at the mortgage data, and we look at the bank branch data. And as we showed in the figure, there is a lot of variation across different disasters. Specifically, we look at ones that receive FEMA accreditation, so ones that are at the level of federal emergency fund data. And when you do this, you see that that disaster exposure effectively implies that there's a 12.4% faster growth in shocked markets, right, in areas that were hit. So there's a lot of credit demand in those markets. And this is banks now pulling that credit to supply it from other markets. So to conclude, there are negative effects of natural disasters that are shared across financially linked markets. Those financial resources flow from the unaffected markets. Now, it is then a good thing that we have this financial integration, because if there's excess demand in one area, then we're able to meet that demand. However, we have to be mindful that that is a credit supply decrease in those other areas. So that spillover effect happens. Now, securitization aids that banks do fund this new lending, so it has a minimization across their core markets. Remember, they're able to shield their markets where they have branches. But multi-market banks then are really cognizant of this, and they try hard to make sure that those areas with their branches remain, in a way, safe from these spillover effects. So I think with that, I'm going to conclude. Again, thank you very much for including me. And I just want to say that the more research we have on this, I think is going to really allow us to better appreciate the effects overall of climate risk and the understanding of the importance of financial integration. Thanks again.